In this video, we're going to look at think through some of the things that would affect the consumer price index and inflation. So I have this listed together, and there's a reason for that. So we talked through some of what's in consumer price indices, the consumer price index. But really, the reason we are interested in CPI is that it's a measure, an observable measure of this bigger concept of inflation, right? And that we as individuals experience inflation differently, where inflation is price changes over time, right? So some of us may have more inflation than others, right? So if you're, for example, in the United States, if you were a large consumer of healthcare and college textbooks, you would have experienced very significant inflation over the last 20 years. Whereas if you were a consumer of flat screen televisions and soda pop, you would have experienced significantly less inflation. And so, again, that different basket of goods matters, but we have this concept of inflation, where the concept is that prices change over time, and we want to be able to measure that, and that's CPI. So the measure is itself a little different than the concept, but we want them to be as closely connected as possible. And because true inflation as an idea isn't really observable, we have rather things that we think are related to it that are. So that's our CPI, and it has all those major components and is really a basket of goods that represent the purchase of a typical consumer. So what we want to think about in this lecture is what are the things that might drive changes in the CPI and then therefore inflation. So what would make CPI larger or smaller? And so to get there, I want to think through a simple little thought experiment. We'll start with a small sort of toy model of how prices might work, and then go into looking at the data. So we'll actually look at some output, some analysis output from an economics paper on this exact question. But let's start with what we think might be relevant. So we're going to create this simple little world. So we're going to imagine an island nation. It's very small, not very many people on it. Really only has a few major products of interest, namely coconuts and fish. So we have some coconuts and we have some fish out in the ocean. My brother spent some significant amount of time living on the island of Tahiti, and he was really tired one day and decided to take a nap under a coconut tree and just got absolutely chewed out by the locals. I mean, it would be like riding a motorcycle in the rain without a helmet on in the U.S. I mean, you could do it, but people are going to tell you that it's not very smart, right? So sleeping under a coconut tree is a really bad idea if you're from a place and have been there long enough to know that coconuts will fall and kill you. And so but we've got coconuts, right? So we have coconuts on the island. We also have fish. And just for purposes of us thinking things through, we're going to add this unique geological feature, and that there is a cave in the heart of the island that's protected. It's guarded by the government. There's serious looking guards at the entrance the whole time, so no one gets in or out. And inside are a bunch of beautiful gemstones. You can just walk in and maybe grab a few and come back out. And so if with permission, if the society decides, they can send someone into the cave and come back out with more stones. Or I suppose in at a different sort of situation, they could take stones already out of the cave and put them back. There's no reason why they couldn't go either direction, but you just heard of this general notion that there's these fancy stones and there's only so many of them circulating around, but if we wanted to go get more, we could. We just have to wander into the cave, but that's typically forbidden. So under normal circumstances, the number of gemstones is fixed. And there are people on the island, but not very many. So you can imagine a situation where we have people harvesting fish and harvesting coconuts, and there's fish and coconuts kind of wandering through the island, and that a certain amount of gemstones would correspond to a certain amount of coconuts or fish, right? That these commodities would have prices, and so if you were trying to host a feast, like a wedding feast or a holiday feast, you would need a lot of food to provide for your guests, and so you would exchange gemstones for some extra food that week, and then later on maybe you wouldn't need as much because you were going to someone else's big dinner, and so you could be accumulating gemstones that week. Obviously there's lots of things you could be doing, but we'll just keep it very simple, just to a couple commodities. And we can imagine, okay, given a certain amount of coconuts and a certain amount of fish and a certain amount of gemstones, if everything stays constant, that the price should stay roughly constant. I mean, that's a conjecture rather than something we can prove empirically given this small setup, but at least we can appeal to logic to say that, well, it just makes sense that these prices should be roughly stable since everything is stable. So then I have, right, the last line there is a reasonable follow-up question. So what would make prices change? So let's imagine that somebody gets to be very entrepreneurial and they decide to purchase a bunch of coconuts and create a plantation. Rather than just waiting for wild coconut trees to grow, they're going to go do some intensive agriculture and plant a bunch of coconuts. So let's think about that, what that means in the short term. So in the short term, we have a decline in the number of coconuts available for consumption, right? So that's important. You think about this, right? There's a bunch of coconuts that have disappeared because they're being planted now instead of consumed. So the number of coconuts floating around for people to eat is lower. And so we call that, in economic lingo, we call that a supply shock. There's been a shock to the supply of coconuts for consumption. It is now smaller. And so we have the same amount of people and the same amount of gemstones all competing for a smaller number of coconuts. And so what naturally happens, right, is if, let's imagine that I'm having a feast and it's really, really important to me that I have coconuts available for my feast, I might be willing to pay more gemstones than is typical to make sure I get my supply. Whereas somebody maybe having it for family dinner will notice the increased prices and say, well, at these prices, I'm not interested in doing coconuts. I can just do something else, right? So that would reflect an increase in prices, right? That the cost of coconuts for consumption would rise because the supply of coconuts has received a negative shock. And the argument that the price would increase is a simple supply and demand argument. If you have the same amount of people wanting just as much as they used to, but now there's less available, somebody's going to have to be disappointed, and the way that's going to be sorted out if we let prices move is that people who really, really want them will pay more, and people that didn't want them quite as bad will sell them and accept higher money, right? So if you were on the boundary of wanting coconuts, now you're out. Whereas if you were really sure you wanted them before, you're still in. And so that has a tendency to drive up prices of coconuts. So again, what we're talking about is a supply shock to coconuts for consumption. Right? So in the short term, prices for coconuts go up. Now, what about fish prices? We haven't affected the supply of fish, but we have affected the demand for fish in the following way, right? If you remember the family if you're having the party, right? The parties always consisted of coconuts and fish, and after the supply shock to coconuts, the party is consisting of coconuts and fish. So that stays the same. So on the party side, there's no price effect from the party other than the already recognized increase in coconut price. But think about the family, right? So the family that was on the border for having coconuts in the first place now has opted out, right? So we're not going to do coconuts, but they need to eat, right? So it's a reasonable expectation that they would then turn to fish at least a little bit, right? So maybe overall we know it's not physically possible for everyone to have as many calories as they did in the past, right? But that, because the total number of calories circulating for consumption has declined due to the supply shock in coconuts. But that some of the demand for right, the depleted demand for coconuts because of the supply shock can spill over to be an increased demand for fish, right? So, which would mean then we have more. This is not a supply shock for fish, but we have a demand shock for fish. We have more demand for fish due to the coconut price increase. And so demand increasing by a similar argument, right? If you have supply and demand, demand increase means we have higher prices because we have people chasing. All else equal, we have more people chasing the same amount of fish, and so that's going to drive up price. So a supply shock for coconuts will, in the short term, will drive up prices for coconuts and drive up prices for fish. Even keeping, right, the number of gemstones the same. So we have the same amount of gemstones, it's just that now we're trading coconuts and fish at higher gemstones amounts. And that means everyone who had gemstones in the past now is able to purchase less with those gemstones. And that's, in effect, right, so that the result of that is inflation, right? So everybody's gemstones now don't buy as much stuff, right? Fish is more expensive, coconuts are more expensive. In the short term, now, let's think about what happens long term, right? So long term, we've planted some coconuts. A couple years later, they grow into handsome coconut trees, and now we have a bunch of coconuts. So in the past, so that next year, the supply shock for coconuts is over. They were planted last year, so we're back to normal levels of coconuts, fish, and probably normal prices. But then, once the production for coconuts come online, what happens? So this is a supply shock for coconuts again, but in the other direction. Right now we have more coconuts than we did in the past. There's more calories available consumption on the island. And so we have an increased supply for the same demand, and that would drive down coconut prices. By similar token, right, now that coconuts are less expensive, a family on the bubble for buying fish would switch over to purchase coconuts. And so fish prices could also be expected to decline. And so now, given the amount of gemstones in the economy is fixed, the prices for coconuts and fish have both declined. So the gemstone savings are now worth more in terms of coconuts and fish. So a positive supply shock to coconuts led to price declines in coconuts and fish, and deflation, right? So that's what we call it when prices decline. We have deflation. Deflation is economically problematic because let's imagine that we had deflation of 20% a year. Well, that would mean that if I spent a gemstone on 10 coconuts now, if I wait, I could have 12. Or maybe let's make it 10%, right? So if I could wait, I could have 11. If I wait some more, I could have 12 and some change, and then 13 and a little more, right? So that's a very serious, that's a very quick growth in my, it's very quick growth in what I'm able to purchase, right? So if my deflation is happening at that kind of rate, it doesn't make sense to spend money at all, right? I wouldn't want to spend any money. I just want to hold on to it because I'm becoming rich really quickly. And that's very concerning from an economic management perspective because if everybody wants to do this, then it's the result is that you have an economic crash, right? No one's spending any money, so none of the businesses are generating revenue. It causes problems. So you get you can get what's the concern is called the deflationary spiral where we're not investing, where we're not spending, which causes deflation, which causes to not spend more, which causes more deflation, and we go back. So the general assumption by economic planners focusing on tweaking the inflation levels is that that inflation is generally preferable to deflation, that a little bit of inflation is fine, especially if you can plan for it, right? If it's consistently 2%, like the Federal Reserve targets for the United States, then everyone can sort of base their planning horizons around this change, and it doesn't do much. But whereas deflation can cause this spiral. So again, this is like really simple, a very small model, but right away we get to normal behavior in investment leading to negative supply shocks, leading to inflation, and then we have GDP increases, right? The results of the investment leading to positive supply shocks and deflation. All of this happening outside of the amount of money. When we think about inflation, your first thought is, well, prices are going up because there must be more money. And as we say later, that's often true. But that's not the only way that we can affect inflation, right? So just from the simple example, we can see that that increases in investment can cause inflation. Increases in productivity can cause deflation, right? There's real economic, the real economy, like the actually making stuff and hiring people and doing things economy can have an effect on inflation. Of course, the monetary effect is more direct. If we fire, if we tell the guards to stand aside, go down there and come out with armfuls of gemstones and double the number of gems, right away, prices all over the island should double. Because we have this immediately double the number of gemstones chasing the same amount of stuff, no matter where it was, right? We could be in the middle of deflation, and now we're double the deflated price. And so that's why economists tend to look first towards monetary effects when they think about inflation, because it's so easy to directly affect inflation with monetary effects. But the real economy plays a role too. So, to get into the details about what actually are the major effectors, monetary and otherwise, that drive inflation, we're going to take a look at a paper. So here, there are 4 authors, 2 from UW-Milwaukee and 2 from Southern Illinois University. And the name of the paper is Determinants of the Inflation Rate in the United States, and a VAR investigation. So the VAR stands for Vector Autoregression. And so that's a statistical model of a particular type. It's used for if you have a series of data over time. So think about maybe a temperature at a particular weather station in the United States, or you'd have 120-year history of the temperature over time, and that would be, and so you could model that using an autoregressive model, which basically they tend to look like, well, let's predict one step in the future, looking at a few steps in the past, and there's maybe a certain pattern, like when it goes up, it tends to keep going up, and it goes down, it tends to keep going down, something like that. The model will figure all that out. So that's an autoregressive model, a really crude description of an autoregressive model. A vector autoregressive model is, well, what if I had 5 or 6 weather stations all in Iowa? Well, they're all going to have their own temperature data, but they're also going to, in effect, be influencing each other, right? So if a cold front is coming in from the west, right, the westernmost weather station is going to experience a dip, and that will be predictive of dips coming in the other weather station, right? So these things talk to each other, and so a vector autoregressive model says, well, let's take our list of things and track it through time and model how we think they interact with each other based on the observed history. So again, this is not a statistics class. We're not going to get into how all of this works, but we want to just understand the concept of what it's doing using the history of a series of data items to try to anticipate what's coming in the future and use it to make some inferences about what actually caused inflation. So they have some data they use. These are long-term series, right, over years and years and years. The first is GNP, so Gross National Product in the United States. Seasonally adjusted, that matters, right, because the summer and winter have different output patterns. A really, really cold day can have a serious impact on economic output, but we adjust it out. So in general, we have a measure of economic productivity. AAA, that's the interest rate on highly rated corporate bonds. So it's basically it's just a measure of interest rates. These are corporate interest rates rather than government interest rates because they're not the federal ones are directly manipulated by the Federal Reserve. So the corporate bonds will be indirectly affected by what the Federal Reserve does, but yeah, so this is just a general notion of interest rates, and you can kind of imagine how this would work, right? So if interest rates are high, that makes investment attractive, right? So foreign investors will want to come and invest in American financial instruments because the yields are really good, right? They get a lot of returns. That's going to drive up the value of dollar-denominated debt and, in fact, drive up the value of the currency, right? So higher interest rates make the currencies worth more. Lower interest rates make them worth less in the long term. And as, right, of course, as currencies are worthless, they buy less in the international stage and effectively create inflation. So economic output, interest rates, money stocks. So there's M1, M2, M3. There's lots of different definitions of money stock. This is the really crude one, and or the very this one, that one is the most closest to specifically currency, paper currency, and not loans or bank deposits or other things that get there. Producer price index, that's commodity prices used to make stuff, right? So if the raw materials are more expensive, we could expect that might feed into inflation later. So that's the base model. Those are the major ones. And then we have 3 minor factors that might have an effect. So wages, that might be kind of a surprise to think about it, right? But if you're making more, right? If people are making more in general, they have more in their pocket. Competing for essentially the same services. That's not totally true because we're also get things on the global stage, right? But we can kind of imagine that, if there's only so many nurses and we're all making more money, we might have to pay more for our nurses because we're all fighting over the same number of nurses. Also, right, that nurse that we're hiring is costing more because wages have gone up. So there's a bit of a cycle there. But that's not, so we can understand the logical connection there, but it's an empirical question, right? It's a data question. How strong is that connection? The next is budget deficit. So when the government runs, especially the federal government, when the federal government runs a deficit, there's a reason to suspect that this can lead to inflation. So in particular, so let's say we imagine that, just to do a really simple example, what if the entire United States had exactly $1 of currency floating out there, and then the government ran a $100 budget deficit? Well, that means that they've committed to pay a bunch of people $100, and they don't have any money. So they're going to have to finance that. So generally, they'll do a bond issue, right? So they'll issue some debt. So let's say there's a $100 loan out there that pays interest, and then so they pay $100 loan, they get $100 worth of whatever, so they sold that $100 loan for something, and then what they sold it for in turn gets distributed to all the people that they promised to pay, right? But that $100 loan, again, it's sovereign debt, it spends like cash basically, right? If you even though there was only $1 in the economy, having a $100 loan from the federal government is as reliable as having a $100 bill, basically. It depends on the government, right? But if you have a credit-worthy government, and so deficit spending, all else equal, should be inflationary. But of course, all else is rarely equal, and in particular, the Federal Reserve is very aware of the naturally inflationary result of government deficits, and take actions to offset the results. And so after that adjustment, we might not actually see empirically budget deficits causing any inflation. It's also important to note if the government is borrowing from their own people, right? So if $100 is coming out of the hands of people and they're getting these loans, then that money would have been spent on something else rather than on the loans, and so it becomes a substitute, right? They're lending to the government instead of consuming or investing in something else. And so if it's all internal, then it won't be inflationary because the $100 that is coming out of the system, there's $100 coming out of the system into the hands of the government, and then it's going back out again. So it can just end up canceling each other out. But but if it's like a foreign investor, that can be different. So all of those things get complicated. But there is a very good reason to suspect that running large budget deficits can, on average, tend to be inflationary. But empirically, we can ask, well, does this really happen or not? Can we look at the history of inflation, its changes in the CPI, and see a connection here? And lastly, energy is always going to be a suspicion, especially since the oil crisis in the 80s when it shot up so high and then the inflation was really high at the same time. So it's just kind of a usual suspect. So the top four, they consider their base model, and then the bottom three are different examples of things that might matter. So again, just conceptually, we're thinking about, right, is if we can look at this history, right, we have 7 variables, track them over time, and you can kind of just imagine intuitively, right, if we see GNP spike, and then we see inflation spike immediately after, that maybe these are connected and that the one causes the other. Or, right, if money supply spikes and we see inflation spike immediately after or at the same time, or, that the changes in one can lead to, near in time to changes in the other, and if it's a consistent pattern we see, then what's a connection we can make? And so the vector autoregressive model does that. Now, the authors don't ever run all 7. They do the base model plus one additional variable 3 different times, right? So they have 5, and then 5, and then 5. So this is basically the outcome of what they get. There's a lot more in the paper. You can, I'll put a copy of it up on the course page. But here we've got our base model there with we're trying to predict the price level, right? And we have our base model variables, right? So we have money supply, the interest rate, and economic output. And so we have this, right? So we have direct causality. The reason that's in there is you can think of a good example of how this might go. So let's say that we have more economic output. So now we have more things available to buy, which would tend to drive down prices. We have the same amount of money chasing more stuff, and so on average, the money should buy more stuff. But the government's response to a large GNP might be to increase the money supply and cancel it out. And so we might not see inflation because of activities around the money supply. In that case, right, if money supply ends up causing inflation, it could be that the GNP indirectly affected it, right? That maybe, an increase in GNP caused a increase in the money supply, which caused inflation. And so if you back up enough steps, it did it, but it's not a direct channel. And so identifying whether or not it's a direct channel is something you can do in a vector autoregressive model just by looking at how the data interacts, especially over time. So in our first model, we have that base, and then we're adding wages, right? And that percent there, that's like it's basically the percent of the volatility. And so we see money supply is the biggest effect, basically by double of anything else, right? The amount of money circulating in the economy is the biggest direct cause of price changes. But that wage, right, that additional variable to the model, that we have our base model, but then we add everybody's wages, right? When wages are high, that's also a direct cause of inflation. Now, according to the data, right, if you look at the strength of the signals, it's much smaller, right? That money supply is a much stronger signal of coming inflation than people making more money. But that this is a more direct effect than, say, an interest rate, right? Again, because we have a scenario, right, where interest rates go up, our currency becomes attractive, investors buy it, it becomes more valuable. Now imports cost less, right? There is a direct channel where interest rates could be playing into inflation, but it's not strong enough to be observed in the data, right? The only inflation we see in first rate calling is an indirect channel, right? The direct causes our money supply, and then wage, right, the size of wages. But, about half. So that's that first model. On the second model, we have, you can see those values are smaller, so it's not working as well as the first model. But we still have a money supply being a big direct cause of inflation, and we have the budget deficit. So, this is not as strong a story, right? We can have a very clear connection between wages being higher and things being more expensive. Budget deficit's not as clear, but still apparently true, right? So, and in fact, in that model, it's as strong as the money supply. But the whole model is less predictive than in Model 2. So we're not doing as good of a job explaining what's going on, so things become sort of muddled. But you have this really strong signal that, in fact, budget deficits do cause inflation, and as much as printing more money. And so, we look at, if we look at the history of recent budgetary federal policy, we've had, small budgets and large budgets. But I mean, the recent history of the federal budget has been one of perennial deficit. And so we know empirically from data that this is a cause of inflation. So with absent something else intervening to prevent inflation, we would expect to see inflation. And we haven't. So so that's probably to some degree intervention on behalf of the economy to prevent it. Model 4, we're not looking at wages or budget deficit. We're looking at energy prices, and you can see this is very, very strong, right? That it's in fact the strongest predictor of, or the strongest most explained volatility. But basically comparable to money supply. And this squares with our experiences, right? When so much of our economy is dependent on fossil fuels, in particular agriculture, right? So if we have very expensive fossil fuels, farming, it's hard to dry corn, it's hard to, fuel the tractors, and you have all these factors that then spill into other products being more expensive. Again, because it's highly volatile and at the base of a lot of other things. And it's actually energy price inflation that drove a lot of actually policy. You think about things the government does, right? The Department of Energy exists as a response to drastic increases in energy prices. And so we get energy itself causing quite a bit of inflation. And but once again, right, we have interest rates not having a direct effect. In this case, economic growth does have one, but it's small. So but everything is affecting it, but some of them are direct channels and some of them are indirect channels, and that's important, right? So if we think about, right, so we've had a consistent for a long time history in the United States of low levels of inflation. I mean, I guess not a long time, but at least 15 years, 20 years. Relative to the 80s, we haven't seen inflation like we did back then. And so we would expect then that this outcome might be the result of a stronger control of the money supply, or the stronger control of the money supply, or some of these other factors weighing in. And there's some historical context to that too, right? So when the dollar was trading at fixed ratios to other currencies, if we were doing inflationary policies and weren't letting our currency change, then that stress would be pent up over time. And so then once you have suddenly a release of that where the dollar quick snaps to its true value relative to other currencies, then we see massive sudden inflation because now the dollar has massively dropped, which isn't really the true history, right? In fact, maybe it was declining over time, but because it had been stable it wasn't allowed to get to its true value, and so when it corrected to the true value, it was a sudden and shocking correction. That doesn't happen anymore because the dollar is allowed to trade freely and float relative to other currencies without restriction. But that wasn't always the case. So that's at least one academic data-based endeavor to figure out what causes inflation. Partly, CPI is a number that moves the world because it has direct implications on interest rates. If you think about why does your mortgage have the rate it does, a big part of that is not just inflation, but inflation expectations. And so understanding the causes of inflation feed directly into inflation and then feed directly into interest rates. So that's where we're going next. So in the next video, we're going to take a look at how interest rates and how they connect up with all of this discussion on inflation and the CPI.